This is the Shanghai benchmark gold price premium to spot, meaning what is the premium to spot in China? Why is gold trading higher than in China than it is in the US? Almost all the time it's trading higher, with the exception of 2020, a little bit of 2021. It traded lower in China, and a lot of that had to do with the COVID pandemic. Meaning, who's bidding the market up?
Welcome to Gold Silver Pros.
Hey everybody, this is Robert Keens of goldsilverpros.com. I'm recording this on Thursday, October 6, 2022. Can't believe we're in October, but it is here, and fall weather is here, which is actually nice, being in Texas and being hot. This is going to be the third part in a series on the ability of the CFTC to regulate the commodities markets, and specifically the gold and silver markets. I have contended over the last couple of years that they were not tasked with the right resources and enforcement abilities and tools to basically regulate that market. Therefore, nobody can in the government can effectively say that the commodities markets are not manipulated. I think the first two videos in the series, if you go back and look at them on our YouTube channel, go over a lot of the testimony of a former deputy director of the CFTC who was in charge of doing surveillance, and that role was detection of market manipulation and sending that information on to an enforcement division of CFTC. He had both a presentation at Silver Symposium about a month ago in Washington, in which I was a speaker on the main stage, and also he showed up in one of my sessions, which was a surprise. We're supposed to be doing a session on mining stocks, and he showed up, and instead we just had a session on what he did at the CFTC. Although he cannot provide us information on specific investigations, he could provide us information on how it's structured, what they do. In the first two videos in the series, I basically took a look at that and felt like it edified what I'd already thought, which is that the CFTC, although it has a lot of good people there and is meant well, does not have the resources, the capabilities, the tools and things to effectively surveil and enforce the rules of the commodities markets against the main players, specifically the largest traders, which we have talked about a lot on this program. So without further ado, we're going to jump right back into it. I'm going to get back for just a moment or two on the videos, conclude that piece of it. Then what I'm going to do is I'm going to go over some research I'd done previously from a gentleman that was a Florida law professor that has talked extensively about not only the commodities markets, but the markets in general. And he wrote a paper back in the 90s. Is great, which is a good view 15 years after the CFTC was created back then as to how effective they were. And he says basically not. And because that research edifies some of the things that were said in this interview by the former deputy director. In other words, the problems have been there since CFTC was created in 1974, and a lot of them haven't been solved. So therefore, in order to help the government out, in order to create a better and safer and more legitimate market for traders, I've created a presentation which goes over what I think are the main flaws and I think what the main solutions could be. And again, I do this because I was a former auditor, and this type of thing I used to do every day in corporate America for multi-billion-dollar corporations. So we're going to do that here. I wanted to point out that my view on the CFTC and the regulatory abilities and manipulation of the market has not changed. It's actually, I think the case has gotten stronger, that we know that the markets can be manipulated and are manipulated. Of course, we've got all that case history in the past of all the companies that that were fined or had some legal action taken against them for manipulative practices, specifically in the precious metals, also the treasuries, and that there was a $920 million fine handed out for JP Morgan, the most recent one, for manipulating the precious metals and the treasury market. There have been other ones certainly in the past as well. I'm not going to go over all the legal cases because I'd previously written an article about this on Seeking Alpha and also done a video on it. But if you want to know that, we can definitely put that information in there. So without further ado, let's go ahead and get started on going through his videos. We're not going to spend too much time on video work on this episode, just a few minutes, but there are a few last pieces of his testimony that he gave in the meeting with me that I really wanted to go over, and a couple of pieces out of his main presentation. So here we go.
Sure, it's unsatisfactory. My own view is the punishments are never near enough. All right, I have been an advocate for, my belief is that if you want a firm to change its behavior, the punishment has to impact the shareholders or the owner significantly. It has to be harsh. Big punishments may be a big dollar value, but it may not register as something that affects the board and the C-suite. All right. So I'm a big believer in that. There are different issues and different arguments about criminal punishment. DOJ is criminal, CFTC for the most part is civil. There are some constraints there, and I'm not happy with them. And I believe, again, that more cases should go to trial and get really maximum fines. Things don't go to trial, they go to settlement for all sorts of reasons, including resources, right? That trials are expensive for government institutions. So I won't say there's a formula, but you know, you look at it, and I think CFTC's is $160,000 per infraction. You got to be using that type of number in your calculation. 160,000, how many infractions were there? What happens if is one manipulation $160,000? Is one spoof $160,000? Is one attempted spoof $160,000? How do you add them all up to get to a number? I think that those types of constraints are wrong, and that the objective of government should be to dissuade illegal conduct and to incentivize compliance and the expense of building internal systems to detect it internally. And I also believe that the law should be that it's mandatory to report to government the detection of a potential violation. That's true at the FCA, all right? In England, if you have a potential violation, you're obliged to report it to the government. We encourage voluntary reporting, right, as a mitigant to the fine. You said, I caught myself, I'm reporting myself. But you don't have to report. If you don't report, you don't get caught. What does that mean? So I'm in agreement that my personal view is to dissuade illegal conduct. The punishment has to be harsh, you know, particularly since it's only, for the most part, it's only money. Got to change the attitude of the shareholder and the board, right?
We're going to go ahead and wrap it up because I think we have another group coming in.
By the way, thank you so much for coming in and answering these questions. Thank you.
All right, that's pretty much it with that one. And the comments there are pretty astounding, and I thank Matthew for making them. And this is where I think Matthew is just a really honest, good guy, and I've said that several times during the series. And I think he really intends to do well. He's basically pointing out a lot of this goes to trial, and when it goes to trial, the burden of proof is really excessive. We covered that in video 2 about the legal part of it and what you have to do to prove it. And I'll get into more on that here when I get to the research paper in a moment. But not only the burden of proof, but it's so expensive, nobody wants to do it, and they all settle outside. And when they settle outside, it doesn't have the bearing of an actual legal conclusion that a settlement would, because you don't get like any sort of verdict, and you don't get necessarily culpability. You just get somebody paying a fine. And not only that, but he said, you know, essentially the standard to get a lot of these through that process is very, very difficult. So obviously that doesn't work in the research I show you here in a moment, done independently outside of these sessions will show that. I'm going to go to video 2, and we're going to talk about data types and quality. We're going to do this real quick, but this is really interesting. This is in his presentation about surveillance and his view on the data. I find his comments very interesting. Let's listen to them. And sharing screen, here we go.
So major violation, of course, for me, is manipulation. I care about manipulation more than anything else. Most manipulation is benchmark manipulation. Minor violations are all the per se violations. You didn't fill out the form, you had a position limit violation, all the small stuff that's in the rules and regulations. Okay, so most minor violations, right, tie somehow to record keeping. Major violation is always about price benchmarks. All the ones that you follow in the press that are big are like the Barclays case, where they manipulated the gold fix to get at the value of a derivative. All right. Okay, so This is the truth of the world of surveillance. Every trade and every position creates an audit trail. The fingerprints are there. You need to know who's acting, who controls the activity, and what are the related positions. If you get lucky, a speaking document will exist that the lawyers will like that says, I am guilty. Lawyers do not like data-driven cases because lawyers, for the most part, cannot look at the trade record and understand that this is a language like Turkish that is saying that I killed my wife with a knife in the library, where if they have a note written in Turkish that said that phrase, since they don't read Turkish, they would say they don't have a confession. That's the problem. All right. Okay, so this is what the market is made of, all right? The data for futures and options that the CFTC can see is fabulous. It's at account level, right? So I can see, and people were always surprised. They say, can you see me in the cattle market? Oh yeah, you're right, 9:02 and so many microseconds. I see you placed an order. I see when it was filled. So that data is fabulous. It's highly detailed, and there are two levels of it. One is transaction and position, and then the other is messages. Just what was sent in and didn't get filled, right, was unactionable. Swaps and swaptions. Let's see, swaps and swaptions. Another level, the data is very good. You can see the actor, you can see formation, and we can get information behind the transaction from the participant. Let's see, one more. And the last one is physical. The problem with data is the physical data doesn't exist for anybody. It's not collected. So if you say, what happened in the silver market yesterday, in the cash market, in spot London, right, as it traded throughout the day, that's not collected, all right, and doesn't exist. As no other agency collects it. Treasury doesn't collect it. Foreign exchange. Who's collecting the cash data? Nobody. It's not regulated. And what does that mean? That cash markets, trading platforms, even big ones, are not regulated by anybody. And if you've been following the crypto world lately, there's a bill that was proposed by the Senate to create regulations under the authority of the CFTC for crypto commodities. And that would be the first time that the CFTC would have cash market authority. And we'll get a little bit, I would say it gets a little dicier, it gets a little.
So I'm gonna stop there for a moment and do this in two parts. What he's saying here is this is the market. They have access to some of the data, not the other. The main one they don't have is physical trades transfers, the cash market. He says they have ETF data, but I'm wondering if all ETFs, so if you look at SLB and GLD, for example, do they have that ETF data, or is it other ETF data more specific to what may be traded on the exchange? That's a little unclear, but I'm pretty sure he doesn't mean all ETF data. But interesting to see what he has here. There are more on the data that I think you find very interesting. Let's keep going.
A little more interesting. So there's no data that's collected. So if you say to me, can you see what happened in the agricultural space? The answer is no. Can I see what I saw? Can you see what's happening in the treasury space? No. Can you see what's happening in gold, silver, platinum, palladium? The answer is no. Can we get data from different sources and put something back together? Yes. But it's not collected or regulated in a official way, where the derivatives markets are. So as an example, sometimes information will be shared. Information is easily shared if there's a memorandum of understanding or a subpoena. Surveillance does not generally have any access to subpoena. So information is to do ordinary work, just to look at what were you doing at 2 o'clock yesterday with the trade that you posted of 3,000 contracts. I have to make a request under an authority to get that information. It's not collected ordinarily. The resources of the surveillance group, and I will argue of the commission, are incredibly tight. When I joined in 11, I had 69 staffers. When I left, I had 12 analysts. You cannot look at near 100,000 different instruments and millions of open swabs with 12 people and say you're going to find everything. We will find things. Are we looking at the right thing at the right time? Probably not. Forensically, can we find it later? Sometimes yes. All right, if the data exists, we can see it, we can find it. Okay, so the problem with curiosity.
Okay, here we go. So that's enough now. The main thing is no cash data. So how do they link the cash settlement in the physical market to the derivatives? They can't. Well, if they're using the derivatives to cash settle certain things, I don't know. It just seems like you would want that data in there to see who's doing the physical and then use that information to compare to derivatives and see if there's some intent to manipulate that price for people who are physically settling. That just seems common sense, seems like a big miss there. The other thing he said there, which he also said in our roundtable, but he said it better here, or more succinctly here, was we started in 11, he has 69 resources. He told me during the roundtable he would need the other session, which is an earlier video, he'd need 2,000 to catch everything. So with the 69, they weren't going to catch everything. Now they have 12. They're certainly not going to catch everything. And so here you have this agency responsible for monitoring a multi-billion-dollar market in commodities, which sets prices around the globe for everything that we use every day, and that's a main underpinning in the economy. And yet we don't have enough analysts basically to do surveillance and enforcement. That's not a great thing. It means that in general, the traders could come to the market and expect, probably more often than not, they could get away with certain types of things. Not saying they'll always get away with it, but if you're only looking at a small portion of the data on a given basis, and it's really just there as a repository for investigations when you get a hot tip, then that's an issue because you're not actively surveilling the market. And by the way, just to reiterate what I said on the second video, I do have a master's in information assurance. I call it cybersecurity, basically same field, but my concentration is in digital forensics. And so I do have official forensics training. I've also done audit and some forensics work as a part of my career, not only cybersecurity, but a lot of other things, some business related processes and accounting and other stuff. So I understand the process for forensics. And the one thing I can tell you, when you have big data like that and you don't have the ability for people to go through it, and just having it as a repository doesn't mean a whole lot, because unless you get every hot tip on every potential bad trade and then you go look at it, just having a repository data doesn't do good. You need to be proactive. Things need to spit out saying, hey, humans go look at this, humans go look at it. They do their assessments. They do them consistently over time. And you need enough humans to do that. And most surveillance processes, whether it be, commodity market or cybersecurity or accounting or whatever that process is, are going to use the same principles. And the principles of having a successful process are not here with the CFTC at this time. It doesn't surprise me that he admitted that, but in any case, I wanted to get that on the record. I've said that before. This is not conspiracy theory. The guy that ran that for the CFTC up until 2 years ago is basically saying the same thing in the public. Not even me asking him, at his own presentation that he prepared for the Silver Symposium. So it's not as though anybody's twisting his arm for him to say that. He's saying it because he believes it to be true. And again, I think that's because he's a good guy. And at the end of the day, I believe that he wants good things to happen. And that's why he's saying that. And I respect him for that. And I appreciate him for that. So we're going to go to the 38:44 mark of same said video 2. And we're going to talk about jurisdictional retail over the data types and quality, a little bit more on that. This won't take very long. Stick with it, guys. On video 2, 38:44. This is very important. All this stuff's super important. By the end of the series, you're going to have all the details you need to know exactly where we stand with these markets. Here we go.
So this is exchange data. We can tell you exactly what happened within 2 hours and built lots of tools to create summary reports about information. My favorite is the price contribution attribution exercise that can be done. As you know, in futures, prices can only change if you cross the bid-offer spread. So you can measure that. You can see if somebody attacks the market in any period of time, a fraction of a second, a minute, 5 minutes, a day, a week, a year, 5 years. So you can get really good view of an actor, class of actors, or any shape of the data that you want to see how people behave. And all it tells you is, it's not saying you're manipulating, it says when this actor comes to the market, this is how they behave. They're aggressive, and they hit bids, they lift offers, and move markets.
There we go. So he's basically just saying what their surveillance capabilities are. Didn't have anything significant to say there other than that it seems like they built some things automated. They don't have the people really to follow up on them, and there are other things missing. But anyway, I wanted to put that in here. This last bit of the video I'm going to show you is where he says it's really hard to find manipulation. Let's listen to him.
Can we miss things? Of course. With budgets that are devastated and limited resources, you can miss things all the time. I've never said, I've told you right at the front, I believe every market can be manipulated, and they often are. Finding it is hard, all right? It's not to say you can't get a good view, and it doesn't mean we don't catch people. We do. We do.
So that's it for the video share. So just to sum up, he's basically saying what I had said and edifying what I'd said. It's really hard. They don't have enough resources. They do have a detection engine. It's not perfect, but it gives them a lot. They can't follow up on a lot of stuff. And he does think that they're manipulated on a regular basis. He said earlier in his presentation, which I put in a previous video, that he doesn't think they're manipulated 24/7. My response to that is, how do you know? If you're not surveilling all the data and you can't validate all these transactions are legitimate, then it means all of them could be illegitimate. It's just a logical either or process, or yes, no process. You know, draw your flow chart. Is a trade manipulated? Yes, go here, do this. Is a trade manipulated? No, go here, do this. Right? Well, if they can't surveil all the trades, how do they make decision whether that trade's legit or not legit? And how does anybody come out and say that they believe that the markets essentially are healthy? I don't know how people come out and say that. I think that's the most obvious thing, that you can't, for all intents and purposes, do that. Okay, we're going to move over to looking at research I've looked at before, and we're going to encapsulate what all of the regulations are for the CFTC right off their website. Let's go right here. If you look at the CFTC, I've been talking about the Commodity Exchange Act, and I've been talking about the regulations that came out of that. Some of what's regulated in the commodity markets is Dodd-Frank, but it mostly has to do with the swaps market, which is part of what we're covering, but not specifically. But in any case, when I go and look for what are the regulations around commodity trading, this is what I get. So we have the CEA, the CFTC regulations, something out of the Dodd-Frank Act, and some other little pieces. There's not anything else. So when we talk about it, it's not like there's a missing regulation we're not talking about here. This is the history of the regulation. And now we're going to get into a paper which talks about that from a gentleman who wrote about it. So we're going to look at a paper I've talked about before called The Manipulation of Commodity Futures Prices, the Unprosecutable Crime. This was published in the Yale Journal on Regulation in 1991. It's volume number 8, number 2, page 281. You can see that here. Originally was published at Florida International University Legal Studies Research Paper 1059 by Jerry Markham. Who is Jerry Markham? Well, he is a professor in the College of Law, or was a professor in the College of Law at the time that he wrote all these documents. I also want to point out he wrote a lot of them. So he's talked about a comparative analysis of security and derivatives regulation in the United States, Great Britain, and Japan. So this guy is like an expert on this stuff. Manipulation and commodity pricing on unprosecutable crime, the one we'll look at. He's looked at banking regulations, insider trading under the Commodity Exchange Act, mutual fund scandals, merging the SEC and CFT, a clash of cultures. I'm going to talk about my recommendations, how the CFTC needs to step up to where the SEC is, and maybe that they need to start talking to each other to regulate, the exchanges across markets. And he wrote an actual paper on that and why that may be difficult. Confederate bonds, derivative financial instruments, privatizing Social Security. This guy's written a lot. He's a very intelligent guy. He's a professor of law, or was professor of law at Florida International University. This is the paper we're going to look at right here, and it's published in 1991. And let me show you before we get down to it. This is basically the cover page: Manipulation of Commodity Future Prices, Then Prosecutable Crime, by Jerry Markham, who is a Florida FIU doing research as a professor. Of course, professors like to do research if they're if that's a requirement for what they're doing. We're going to start on page 71, and I'm going to talk about a soybean case, because there's a quote from a CFTC commissioner, a previous CFTC commissioner, on manipulation that I wanted to include in here to show that there's a history of basically where this has been going on for a long time. So we're setting precedent here. It's not like this is a problem that just occurred out of nowhere. People have known about it. Congress has known about it. The courts have known about it. Everybody's known about this. Okay, that's the point to make. So I'm going to tell you the story about soybean futures and what essentially came out of it from the CFTC commissioner. So it starts here. Another recent market controversy involved trading by Furuzia Fenazzeria, an Italian company that held a dominant position in July 1989 soybean futures contract on the Chicago Board of Trade. Problems with the July soybean contract had begun with the drought of 1988. The small harvest resulted in total stocks of soybeans in July 1989 of only 125 million bushels, compared to over 300 million bushels in July of 1988, just a year earlier. While outstanding July futures contracts on the Chicago Board of Trade on July 10, 1989, called for delivery of 40.3 million bushels of soybeans, there were only about 12.5 million bushels of deliverable grade soybeans at the Chicago Toledo warehouses. A substantial portion of both the long side of the July futures and deliverable side of soybeans were held by Ferruzzi. Ferruzzi's position was so large that the Board of Trade declared a market emergency under its rules and ordered Ferruzzi to liquidate over 20 million bushels. The action sent prices falling, and charges and countercharges were made between Ferruzzi and the Chicago Board of Trade. Among other things, it was claimed that 6 Chicago Board of Trade directors held short positions while the exchange was ordering Ferruzzi to liquidate. The CFTC found no conflict. It concluded that the exchange's emergency action was necessary to avoid disorder in the soybean market. The CFTC, however, did not itself take any action. A CFTC commissioner noted, with respect to the Ferruzzi crisis, that other than jawboning and imposing trade limits, the CFTC was not willing to exercise its power to defer squeezes. Very important. Did not exercise its power to defer squeezes in a market. There's a history of the CFTC not exercising the broad powers it has. It does have power. It has injunctive power and emergency power, and it doesn't always use them. It was also pointed out that the CFTC had brought only a few price manipulation cases in its 15-year history, and that the CFTC had adopted such a narrow interpretation of price manipulation that it was difficult to find manipulation. As one CFTC commissioner stated, hell, it's virtually impossible. Moving on to page 77, we're going to talk about some of the cases brought. We're not going to go over all of them, but I just wanted to point out some of them so that you understand. We're on page 77 here. The small number of cases brought, I'm at the last paragraph, and the very small number of respondents who have been subject to significant sanctions, particularly in contested cases, suggests that manipulation is virtually an unprosecutable crime, according to Jerry Markham. This is due to the difficulty of meeting the standards of manipulation articulated by the CFTC. The government is required to devote an incredible amount of investigative resources to meet those standards. It must review all available cash supplies, fundamentals of the market, the actions of the shorts and assuming delivery, the role of the other traders in the marketplace, and the complicated price relationships between the various futures months. It then must attempt to delve into the mind of the manipulator to prove that there was an intent to manipulate the market. Even where a gross manipulation occurs, the government is still faced with an imposing burden of proving that the price was artificial and that the trader was attempting to create an artificial price rather than exploiting a market situation based upon natural forces. All of this has proved to be a daunting, indeed impossible task for the CFTC staff. Consequently, no surprise CFTC has brought so few manipulation cases. Well, I wanted to point out that in my interview with Matthew, up until he was in this role up until about 2 years ago in surveillance, he said the same thing. So it hasn't changed from when this paper was written in 1991 to 2020 when he left. It's the same. It's almost impossible. They don't do a lot of cases. In fact, it's pointed out in this paper that the SEC In 1 year that this paper was written, had 13 cases prosecuting manipulation under the markets that it regulates, but that the CFTC only had 15 in 15 years, the average of 1 a year, primarily because the burden of proof and the efforts that they needed for intent were so difficult. Now we want to get into the definition of manipulation. We're going to go to page 79 and cover that. And again, all of the stuff that I just covered in this video was the exact same thing that was done in a research paper in 1991. So in other words, since 74, when the CFTC was created, none of this has changed. None of this has changed. Okay. Commentators who have considered the problems, back to the paper, faced by the government in proving manipulation have focused on the difficulty of defining manipulation. Aha. They have proposed various alternatives to the definition applied by the courts, the CEA, and the CFTC. For example, one author taking a lead from the FTC study suggested that a common law principle of prevention or hindrance should be applied to preclude manipulation. This common law doctrine prohibits someone from preventing or hindering another party from fulfilling his contractual obligations. The author believed that a trader buying up the cash commodity and preventing the shorts from delivering would be engaging in such an act. Another commentator would establish a presumption that traders who do not offset their contracts before delivery are guilty of manipulation. Why? Still, another author has argued that manipulation should include some aspect of fraud or deceit. An economics professor would, on the other hand, basically leave it to the markets to decide whether acts were economic and therefore manipulative, which may be what the CFTC has done. And that seems to be that they're relying on that loose standard and letting the market really determine, instead of being able to define it and do it more assertively on their own. This is a problem. Back to the paper. More recently, a law school professor has asserted that the definition of manipulation should be changed and that the court should focus on whether uneconomic acts have been committed. Still going, still on the paper. Each of these authors' efforts to define manipulation and establish a workable framework for prosecution of the offense suffers from the same flaws as the CFTC approach. Even if the definition of manipulation is altered to the form suggested by commentators, courts and agencies will still be saddled with determining whether there has been real hindrance or whether particular acts are uneconomic, fraudulent, etc. The burden of difficulties of proof remain. Moreover, simply defining manipulation will not correct the problem because whatever the definition, the same issues and concerns will arise that have arisen in the context of CFTC, CEA, and judicial decisions. The result will predictably be the same as that reached by the CFTC because no one wants to settle. On the other hand, by simply prohibiting manipulation without defining the term, Congress sought to cover all types, and they tried to do it without leaving things out because Congress didn't want things not to be prosecutable. The problem is they define it so broadly as to be virtually unenforceable. Moving on, about more effective regulation and comparing it to the SEC. This is a really important part that we really need to discuss here because the SEC does it better. And there's a precedence here, and why can't the CFTC use it? This is a removal of excuses is really what we're doing here. The principal weakness in the CFTC's regulatory efforts, back on the paper, has been a desire to avoid interference with market mechanisms, even where price distortions and chaos are threatened. Yeah, we're going to go about 2 pages here. In almost every case where the CFTC has declared an emergency, the declaration came too late to have any effect. Again, that goes back to the CFTC's emergency powers. Don't use them in time. Its use of injunctions, its other power, has been so limited that it is unclear whether they could be effective remedy. CFTC is not even using them often enough. The failure or inability of the CFTC to adopt a mechanism for controlling hedger positions also raises grave concerns about its ability to prevent manipulation. The CFTC's extreme reluctance to intervene in the markets, even during times of grave crisis, is due, at least in part, to the fact that the commodity futures industry has prided itself on being the last bastion of free enterprise, relatively unrestrained by governmental regulation. Well, of course, they don't want the regulators in there because they can do what they want. The industry has staunchly resisted any action which would restrict its unregulated atmosphere. That freedom, however, has not resulted in market mechanisms that are self-correcting or effectively self-regulating. What did he say before? Self-reporting of stuff to the CFTC, which doesn't happen. This has been going on since the creation of the CFTC, and you can't really expect the traders to call themselves out, and it makes sense that they don't want the government involved so they can do what they want. That is a supposition that they're doing things they don't want the government to find, i.e. manipulation. Hello, that's not difficult logically to figure out. It's just inferral. Okay, back to the paper. Undoubtedly, the lack of regulation in the futures industry has allowed rapid growth and innovation, but those are very valuable attributes must be balanced against the fact that the futures exchanges are not playing a major role in our financial markets, and as in the case of the stock market crash in 1987 and the silver crisis in 1980, these markets can seriously disrupt or even threaten the entire economy. That's why it's important. Okay, finishing up the section. The value of a more affirmative approach seems to be proven by the experience of the SEC. In contrast to the CFTC, manipulation is an important part of the enforcement program at the SEC. The federal security laws attack manipulation in a number of ways. These include specific prohibitions, grants of rulemaking authority to the SEC, and a general prohibition against trading for a manipulative purpose. Although price artificially may be required to establish a violation under securities laws, the SEC gives much less cognizance to a requirement of a legal purpose. So you don't have to prove intent, in other words. So the intent function that the CFTC has to prove effectively stops it from regulating and getting cases to the court and prosecuted. This lawyer points it out, how this works in the SEC is not allowed in the CFTC, and then that is a structural deficiency within the CFTC to do what another branch regulating the other markets, SEC, has been doing for a very long time. No excuses here on the CFTC. None. They could do the same thing as SEC. Congress didn't give them the power, and the market said, we don't want to do it. And the CFTC backed off and said, okay, fine. We may not have the authority anyway. And that's why stuff happens on that market. All right, back to the paper. The effect of these prohibitions is very much the same as defining the term manipulation. It is, of course, important in attempting to prevent or punish a manipulation to be able to point to a specific statutory provision which describes the conduct in question, i.e. define manipulation. Hello. But it is doubtful that the specificity of the provisions of the Security Exchange Act alone have resulted in the SEC bringing more manipulation cases than the CFTC. The SEC is simply more aggressive in this area. It is the willingness of the market to do this, not only the law and the definition of manipulation. Important. It's implying that the CFTC is not doing their job, even the job that they could do with what they currently have. That's Jerry Markham's in his paper, and I thought that was astounding. Not one that I'm making here, but it's astounding he says that. For example, in a typical year, the SEC, back to the paper, the SEC initiated 13 cases involving market manipulation, almost as many the CFTC had brought in its 15-year history. All right, moving on to another piece of the paper, page 86 to 87, talking about more surveillance. The CFTC must broaden its surveillance role over the cash market. We're talking about physical trades, cash market. In instances where there is a shortage of supplies, the CFTC must recognize that the market may become congested. In such instances, it must adopt a much more active regulatory framework for limiting the effects of large traders. What have we talked about in the precious metals? The largest four traders: Citigroup, Goldman Sachs, Bank of America, and JP Morgan. According to the Office of the Comptroller of the Currency Derivatives Report, and also the Commitment of Traders Report from the CFTC, these four banks rule the markets. And what does the SEC do? It has rules to limit what the large traders can do. What does the CFTC have? Doesn't have it. See the problem? That's a problem. Now we're going to, I just wanted to mention short seller hammering, because a lot of the people, when I talk to about short selling and hammering the price down, which occurs, and I'll get to that in a moment, which occurs almost every day at the market open in the US, and I'll show data around that, historical data, he's defining that in the paper and saying this is the real thing. And people will say there's no such thing as if you short on a contract and take a long, it doesn't affect the price. And when I asked Matt during our roundtable, which I covered in part 2 of this series, which I did on Tuesday of this week, I asked him about short seller hammering. I didn't call it hammering, but I said putting contracts in to hammer the price down. He said it has a transitory effect, not a long-term effect. But this lawyer seems to have a little bit of a different opinion, and I wanted to read it to you. It starts on page 87. This is the bottom. This is not to suggest that disruptive trading practices of short traders should be ignored. Short traders should not be allowed to hammer or bear the market by repeated large short sales at descending price levels would have all of the cases pointed out short sales at descending price levels. He noticed it back in 1991. Nothing new. A tick test is used in the securities industry to restrict short sales when the market is trading down. Such a test may not be inappropriate for the commodities market. In other words, the SEC says too many shorts, circuit breaker, stop, or a tick test, stop. CFTC doesn't do that. They allow more and more and more short positions, which affects the price. What if we said on the program 1,000 times they allow too much shorting, especially at the opening of the market? He's got it here in the paper. And he's got it pointed out that SEC has a rule against this. So if the SEC does regulating those markets, why in the hell doesn't the CFTC in the commodities markets? It doesn't make any sense. Short selling practices such as gunning stops, selling that unduly depresses prices, and even selling that unnecessarily results in a free fall in commodity prices should be prohibited. Much of this type of trading is done on the floor of the exchange by traders and pits, and now it's all done electronically. On July 26, 1990, it was reported that short sales of some 2,000 contracts caused a sharp drop in the cocoa market. The orders were apparently placed by someone misrepresenting their identity. The CFTC must establish a body of rules that includes a prohibition against sustained short sales in a dropping market and a prohibition against rigged trades made at the closing or opening of trading with the purpose of settling prices for one reason or another. This type of trading could be restricted, for example, by imposing limits on the amount of short trading that any one trader can engage in a given day. The CFTC presently has the authority to restrict the size of daily trading for speculators. Early in its existence, however, the CFTC Advisory Committee on the Role of Contract Markets recommended that the CFTC shift its regulatory emphasis away from strict speculative limits. It did so because it believes such limits provide little control over hedgers, although it's been proven by the SEC this is not necessarily true. So does this occur? Does short selling happen, which hammers down the prices? Well, there's some research that I put out, about 10 years ago on this. I took some research done by a guy called Adrian Douglas. It was printed on gata.org about the mathematical correlation between markets. What he's looking at is how is the market trading away from the U.S.? How does it trade in the U.S.? And there is a extremely, extremely high correlation. If you look at total update intradays, total up days 1085, overnight 1334, down days 1220, 1004. In other words, on the intraday, the trading is correlated 89%. Intraday meaning US trading. Why would US trading be correlated 89% of the time in the same direction? 89% of the time on the gold market, the US trading was the same direction over a period of years from 2001 to 2010. And overnight, it went the other direction. Who's fighting each other? Why does the overseas market trade one way and have a very high correlation? And then as soon as it comes to the US, it gets traded another way. Well, if you dot plot this, 88% of all the data shows this trading pattern, meaning the US is trading one direction, the rest of the world's trading another. Let's think about that for a minute. The US market with these large traders, largely unregulated by the CFTC to stop them from hammering the price down, is allowed to do that. And when the trading moves off the US into the other time zones, on this market, it's done the other way. So essentially what we have are two different markets. One market wants to trade it this way for its purpose, one market the other way. So, and that's all the traders in the market. It's not a specific trader. It's all the big traders, the big four bullion banks that are involved in this trade and all the other parties that take those positions. And it has to be the bullion banks because the bullion banks are the only one that could get an 88% correlation of a direction on a move because they have so many positions when compared with all the other traders independently. Well, look at the Shanghai Gold Exchange. This is right off of goldprice.org. This is the Shanghai benchmark gold price premium to spot, meaning what is the premium to spot in China? Why is gold trading higher than in China than it is in the US? Almost all the time it's trading higher with the exception of 2020, a little bit of 2021. It traded lower in China, and a lot of that had to do with the COVID pandemic. But for the most part, the Chinese price trades a lot higher. You can see in the chart. Meaning, who's bidding the market up? The up days, more of them are not, are being done elsewhere. So more of the up days are done in other markets, not on the US market. And then when it comes to the US market, slam it back down. Okay, there's plenty of data there to show that essentially the rest of the world wants a higher gold price and US traders want a lower gold price. And the CFTC doesn't stop them from slamming it down at the beginning of every day. How many times have we showed a gold chart in which the price slams down as soon as the market opens, on a Sunday or a Monday morning? It happens all the time. And this data just basically goes to show it. So, it's all of this is very interesante, if you will. All right, hedgers and collusion. We're going to get to the last two parts of the research study and then my recommendations, and I promise we're done. It's been a long series, guys. Thank you so much for sticking with. You're not going to find this anywhere else, I'm pretty sure. The CFTC has advised Congress, this is back in 1991 when he wrote this, and I think the original thing was before that. If we look at 580, this was done, it doesn't say, but it's around the time of the paper in 1981, even though it doesn't have a date there. But let's go ahead and read it. The CFTC office, advised Congress that most market manipulation cases had been brought against commercial operators with hedging exemptions. For that reason, the CFTC thought that position limits cannot provide a sufficiently strong defense. The historical reason for not applying position limits was the belief that hedgers are not price conscious. But this has not proved to be the case. Hedgers also have advantages over speculators. Hedgers have considerably lower margins and can obtain financing for their trading more easily. The industry strongly opposed the adoption of limiting large positions, and the rule was not adopted by the CFTC. Among other things, the exchanges asserted that they could not identify the positions of large traders and claimed that they would have difficulty aggregating the positions of traders acting together. That's collusion. So let's say JP Morgan, and I'm just using an example, I'm not saying this has happened, but let's say JP Morgan and Goldman Sachs as large traders wanted to collude. They're basically saying they can do it here. In that connection, there are definitional problems with the terms price manipulation and market congestion. There appears to be a startling admission that neither the exchanges nor the CFTC knows what constitutes price manipulation or market congestion, and it underscores the need for affirmative regulation in the area. Remember when I went back and showed you all the regulation in the area? It hasn't changed since this paper was written. So if this paper is finding that they have not defined manipulation, there's not a whole bunch of new regulation around that has come out since this original creation of the CFTC, then it's still a problem. It makes sense to me. He goes on to state in his paper, the grounds for not adopting the proposed rule also seem to be less than convincing. He wasn't buying their BS, basically, is what he says there. Large traders are required to report their positions every day to the CFTC, and each exchange must determine its open interest each day. It is a simple matter to identify these positions that constitute a significant percentage of the open interest. That information can then be coupled with available deliverable supplies, the cash market, which they don't have data for, and other fundamental information to determine whether a position in any way poses a threat of congestion or disruption. If it does, the position should be reduced to a safe level. This will mean, of course, that a hedger may be placed in a difficult situation. And there are other remedies he has here, additional surveillance and things like that. I'm not going to go over it. You can read it in the paper. I'm going to read the entire conclusion really quickly. It starts on page 97 because this basically mirrors, for the most part, what I thought as well. Here it is. The conclusion of Jerry Markham's paper on commodity market manipulation, which is 111 pages. The history of manipulation in the commodity futures industry dramatically underscores the fact that regulatory efforts on the part of the federal government have been unsuccessful. The wheat kings were almost entirely unregulated until the 1920s, when the Grain Futures Act was adopted. That legislation, however, proved unsuccessful. Thereafter, the stock market crash of 1929 and the precipitous decline in commodity prices resulted in the adoption of the Commodities Exchange Act of 1936. This regulation also proved to be lacking in effective regulatory measures to prevent manipulation. Among other things, it failed to define manipulation and it failed to prohibit particular manipulative practices that could easily be prosecuted. Because of these shortcomings, complicated investigations and extended litigation were necessary to prove manipulation. As a result, cases were often settled with de minimis sanctions, meaning not much. And when a matter was litigated, the government's proof of theories were often found lacking. The split in the circuits between Volckart and Cargill, otherwise referenced, we're not going to talk about it here, caused further confusion, and efforts by the government to eliminate that confusion through legislation proved to be unsuccessful. The limited legislation adopted in 1968 to give the government additional powers proved ineffective. Later, with the explosion of commodity prices in the early 1970s, Congress created the CFTC and granted it with what appeared to be broad powers to deal with market misconduct. This included the authority to impose civil penalties up to 100,000. I think now it's 160 if what Matthew had said in our roundtable is true, and the authority to take emergency action. Those powers, however, provided to be ineffective again. Why? Because they didn't use emergency powers that often, or they used them too late. Also, their injunctive powers, they didn't use them or used them too late. This is well illustrated by such events as the potato default, the assault on the soybean market by the Hunts, the silver crisis in 1988, the stock market crash in 1987, and other episodes described in the paper. The CFTC also inherited the existing difficulty of proving a manipulation case. As a result, it only brought a limited number of cases, often with limited success. Everyone seems to agree that the prosecuting manipulations is central to the regulatory scheme. But the courts and the federal agencies that have struggled with the issue of manipulation have been unable to formulate a methodology that would permit effective prosecution. Instead, they have become bogged down on the elements of intent and economic determinations of whether price artificiality has been achieved by the trading activities of a particular individual or firm. This approach has resulted in complicated trials and discovery proceedings that often require 8 or more years to resolve at enormous cost. These costs obviate any deterrence factor the law may have been seeking to achieve. What did Matthew say in his presentation? What did we cover today? It's too expensive to do this. It's why it doesn't happen. It's why we get settlements which aren't effective deterrents. He said it in his presentation, which I showed you. And Jerry Markham, who did this in 1991, says the same thing. That means the commodities markets, the entire time they've been operating in the US, haven't had effective anti-manipulative practices. So how can anybody, including the CFTC, say that they're not manipulated every day, or that any particular transaction is not manipulated? If you don't have the proper authority, you don't have the proper definition of even what manipulation is. You can't get it through the court system. You can't examine the data because you don't have enough people. Does this feel, guys like you, that they can adequately monitor the commodities market? It sure as hell doesn't to me. It's not just my opinion. This is also the opinion of the guy that was in the CFTC running the detection for this, and a guy that's a legal professor at FIU that's written about all these markets, that wrote a freaking 111-page research paper and got it published back in 1991. All right, back to the paper. The courts and federal agencies do not want to adopt a standard that inhibits aggressive price competition in the commodity future market. As a result, they have adopted an intent test. A defendant must have the intent to create an artificial price. The establishment of such intent and price artificiality raises complex and difficult economic questions. Many fundamental factors may have been cited to justify any particular trading activity. Several commentators have sought to resolve this conundrum by proposing new definitions of manipulation, but those don't lessen the complicated nature. Congress is also now considering whether to move at least part of the CFTC's jurisdiction to the SEC, or even to merge the two agencies. These jurisdictional battles have been waged for years. In other words, everybody's known the CFTC has been ineffective, and they want to put it under the SEC, which has been more effective. That's all that means. It just goes to prove the CFTC is not regulating that market as well as the SEC for lots of reasons. It's not even all their fault, as they don't have all the damn powers or the resources. I'm not blaming the CFTC. I'm just pointing out the deficiency. All right, back to the paper. The stock market crash in 1987, however, exacerbated the situation. Now it appears that the CFTC faces some danger that it could lose some of its jurisdiction. Blah, 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 blah. A simple prohibition against manipulation has proven ineffective. Consequently, more affirmative regulation recommend this article be required by agency ultimately retains or assumes authority over future trading, unless it too wishes to continue in the never-ending succession of crises that have plagued the futures industry virtually from its inception. In sum, if manipulation is to be effectively prevented and prosecuted under the Commodities Exchange Act, the act must be amended and the government must take a more affirmative role in regulating the futures markets. What the hell have I been saying for years? As it is, the paper says, we are left with the words of the FTC study when it observed over 70 years ago that though the evil is specific and is peculiar result of a future trading technique, effective remedies for corners are not found in the present law, at least as actually enforced. There you go. Now, one of my recommendations, we're going to make these really quick. Commodity manipulation. Are these crimes against humanity? Am I overstating it? If we're talking about things that people use every day and the prices determine that, the availability, the marketing of it, the use of it, the either the mining of it or the growing of it or the harvesting of it, and all of humanity depends on that, and this sets the prices and the availability for all that, is this a crime against humanity? Well, I think that's pretty much the damn definition of a crime against humanity. Am I wrong here? I don't think so. Here are the areas needing improvement, the major ones. There are probably a bunch of small ones, but this is the big ones. Definition of manipulation by Congress needs to be by Congress and codified in policies by the CFTC. Get rid of the intent standard. It's near impossible to meet the standard, and the time required mitigates the power to dissuade the actual manipulation. In other words, it's not effective, even if you go through the 8 years it takes to do some of these. The budget cuts and surveillance enforcement funding is horrible, disturbing lack of human resources needed. CFTC does not align with the SEC, which has been more successful. On data, no cash market data and lacking trading book data from large traders. Their actual trading book, not what they're putting on an order screen that CFTC sees, but the underlying data of their traders. Because think about all the financial houses and all the bullion banks that have traders within that they're placing trades for them. How do you determine attribution and intent if you don't know who the end trader who wants those entities to make the trade for them does? You can't stop at the bullion banks and the managed money and the other portables. You need to know the people that are asking these institutions to do this who are ultimately responsible, in my opinion. Otherwise, how do you prosecute it? Automation, the detection agent that Matthew talked about needs work to reduce the impact on investigative personnel. It's good that it's there. It's a good start. Probably got a lot of good stuff in there. It needs more work, I think. I think even he would agree with that because he said some of the things we can't detect in there. So that seemed to indicate he thought there were improvements. The legal process has hindered CFTC's authority and effectiveness. That's obvious. Lack of market awareness of other market-related instruments. I'll get into what I mean on the recommendations slide here in a moment. For that, lack of trader awareness, cannot see their book, weak voluntary data call process. The data call process is voluntary, it needs to be mandatory, and in fact, some of this data needs to be in the system anyway. And I understand that you don't want to, there may be laws around divulging certain information for privacy reasons and things like that. I think those can be worked around and amended where needed for purposes of making sure that we have a well-run market. All right, what are my solutions to the problem? My solutions are, one, and the most important, fund the CFTC with enough resources to create a reasonable expectation of success in terms of surveillance and enforcement. New legislation needs to come out to define market manipulation and provide the CFTC with a common provable standard to loosen the burden of proof of manipulation to more reasonable levels and those adopted by the SEC and other market agencies. Give broad subpoena or similar type of power to the CFTC to get what they need when they need it so they don't have to go somewhere else. Increase fines and develop procedures for stronger, more timely deterrence. Integrate investigations with other government agencies. Well, the DOJ was getting settlements and things, and they're probably using the CFTC data, I'm sure, but they were doing it outside. Why don't you just integrate the information sharing and do like a weekly or monthly meeting on what's going on in the world, awareness, that type of thing between the DOJ, the SEC, and the CFTC. Why would you not share that together? Because if you want to know if a manipulation is going on, you got to look at where gold and silver or other commodities are traded across all markets, whether it be an ETF, a derivative, a futures product, a stock, any of those things, because you could hedge your position one place with a position somewhere else and they wouldn't know. And then what about the London OTC data? That's so opaque. How do you know that you're not hedging positions? One or the other, manipulating COMEX, hedging on London, or manipulating COMEX and hedging on a silver ETF or something. I mean, you need to share data and begin to build that picture, not only within the derivatives, the futures derivatives and the options and swaptions that Matt talked about, but every other instrument which affects what? Those commodities and potentially ownership of them and physical delivery as well. Very important point. My other recommendation is reduce silos and combine surveillance and enforcement groups within the CFTC. Create a common record file for investigations all related parties can use. Why are there silos? They don't need them. Get rid of them. Rid of silos within the CFTC. Trust me when I say, when you have silos, it prevents an end-to-end process from working a lot of times. Not always, but it does. And as an auditor, I saw this a bazillion times. This was an easy one. Easy. All right, next one. Develop more complex rules detection. What I call indicators of manipulation, because in cybersecurity, we call, when we see people doing certain things in certain patterns, this is pattern recognition, we call those indicators of compromise or IOCs. There are tools that take IOCs from vulnerabilities or attacks, put them into a rules engine, and are marketed out to every company and organization that wants it. Why can't the SEC, the CFTC, and the DOJ do the same thing? Indicators of compromise within the markets, we call them indicators of manipulation, and build an automated engine. Why the hell could you not do that? Matt's done some of that with layering and spoofing. Do more and do it not only across the futures markets, do it across all the markets. And now you get a more holistic view of what's going on across the commodities in all markets, all instruments that affect them, not only the ones that CFTC regulates. For example, you could build real-time alerts on overall market activity that would alert people and put it on a storm board, if you will. Monitoring groups do this all the time. You also could generate exception reports for suspicious trading activities for people to follow up on that point out we've got some elements of suspicious trading. Now take a human, go examine that. More of that needs to be done. Data correlation and surveillance of related markets. I talked about outside the CFTCs, ETFs, and stocks and other things. I already talked about that. That's important. And more aggressive limits on positions by large traders, specifically enforced at all times. Oh my goodness, that was a very, very good report. That was a good ending to the series. We're almost done with it. I think at the end of the day, here's what we proved. Through my research on that paper from Jerry Markham and my own independent research on all of the regulations, which I've read through at least once and sometimes many times, white papers on the subject, talking to industry experts, looking at the data every day and drawing my own conclusions as a user of the data, looking at it several thousands of times, speaking to Matt Hunter, who previously was in the role of surveillance and detecting a lot of this stuff and building the engine and all that kind of stuff at the CFTC, and several other things. It's pretty apparent. And in my auditor background and my forensics background, data forensics background that I had in my degree plan at my master's level, putting all of that together, it's pretty obvious, one, the CFTC can't prevent manipulation of commodities markets, and specifically to our program, gold and silver, but all commodities. They lack the ability to do the things that other regulatory agencies do. They lack the staffing to actually detect and follow up on these incidents. The standard for which we could prove manipulation in court is way too strict compared to other standards that exist in other markets and other jurisdictions. It makes no sense. Allowing the market to exist as a freely market with loose regulations obviously hasn't worked. So we need to bring the traders, under regulation, and we need stronger regulations on what gets reported, stronger fines. We need a standard to get things through the court faster so the court's not struggling with all this crap during discovery. All of those things need to happen. But it's very clear that anybody, and I mean anyone, I don't care who it is, short of being God himself, or any omniscient, supernatural power, short of that, no one, according to the CFTC, according to the CME Group, according to commodities traders, according to anybody, could say that this market is completely legitimate, or that they have a certain confidence interval on how much of the market is legitimate versus illegitimate. Because when you can't look at it holistically, and you haven't been able to prosecute it, and you haven't been able to bring deterrence, it seems to me that is a recipe for rampant manipulation, more than likely, or at least certain types of manipulation that never get called and called out, that can occur over and over and over. Why? Because if you're a trader and you can get away with manipulation, you build a software program and you press a button, you just do it. Ding, 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 ding. Manipulate. Why the hell would you not? If I'm working for one of these traders and I know I can get away with murder, I wouldn't just do gold and silver, I'd manipulate the whole thing. Now, I'm actually not going to do that because I'm law abiding, but I'm making the point that I could. And you can automate the manipulation if you wanted. Because on the other side in enforcement, they don't have that. And then they're not going to be able to prosecute you anyway, most of the time. And even if they do, a lot of times it's out of court, and you're going to have made more money than the fine is, and it's not going to prevent you. And usually the guys that get in real trouble are the traders themselves, not the managers, not the directors, not the heads of the trading houses. What kind of deterrence is that? There is no deterrence, at least not a widespread, effective, strong deterrence like you have in the SEC and other potential agencies. But pretty simple. It's not even a hard argument to make that the markets are probably largely manipulated and that the CFTC can't catch it. They just can't. Neither can the CME Group or anybody that runs those markets. They can't. And I think we've illustrated that over this 3-part series. And but what I did here was I wanted to offer some solutions. Jerry offered some in his conclusion. I went a little bit more robust on mine, and hopefully somebody's listening to this and they take it up, and it goes to Congress and we do some things. And take Matthew Hunter and all the wonderful people that were at the CFTC in surveillance, and build them out and bring him back and do more, and let him build that rules engine out. Get a court standard, get more data in there, integrate with other agents. I mean, do what you got to do, but fix the damn problem. Because commodity is worldwide, multi-trillion-dollar market. And it's not only people in the United States that rely on these prices, it's people across the world. People across the world. It affects every company that produces a product. If you're Apple, if you're the CEO of Apple, you want a good regulated, honest commodities market. If you're my neighbor down the street and you're buying eggs, or you want to put gas in your car, it affects all of us. So the reason I put the series out is because my understanding is, in the United States, if we still have a constitution actually operating, which it appears we do, nobody said we haven't, that we, the people, ultimately are the arbiters of the government. The CFTC is part of the government. The commodities trading regulation is part of the government. So we have the right, I have the right to discuss the problems, to offer solutions, to put this out in the public, the right to assemble and speak about these things is part of the Bill of Rights. So I'm just exercising my rights to do this. I'm not unduly criticizing a specific person or a specific government branch. I've said many times, it's not all of these people's fault. They're doing the best they can. It's the failure of us collectively in the Congress, basically, who are representing the time to do this. And so we need to advocate for better markets. And we need to stop pretending that this is not an issue. And further, I'm going to take this one step further. Anybody that's commentating on the gold and silver market, which denies manipulation after watching these videos, probably needs to have your head examined. Now, I know a lot of my friends in the business don't want to talk about manipulation. It's a hot potato topic. I get it. Okay. And I'm one of the ones leading the charge because I'm a former auditor, and I have the balls to do it because I was taught that you try to get to honesty and you try to have effective controls and you try to do the right thing. It's just me trying to do the right thing by all the people in the world that are affected by this. I'm not trying to call anybody out. I'm not trying to hurt anybody. Even the bullion banks and the managed money traders and the producers and merchants, I want them to have a good market. I just don't want them to manipulate or have the incentive to manipulate. So it's just about creating a good market. And it's about we, the people, saying this affects us. Ultimately, we're the arbiters. We're the ones that decide. And that's all this video series was. And for anybody that's commenting on gold and silver, that after watching this series and seeing all this research, and you're not talking about manipulation, why the hell not? It is so freaking obvious that manipulation has occurred in commodities markets for over 150 years, every commodities market, and it's not solved. Why the hell not talk about it? Why do gold and silver people not want to talk about it? Why do news agencies not want to talk about it? Because the manipulators, I guess, are making enough money. Perhaps they don't, I don't know. Or maybe people just don't want to tackle it because they've tried to tackle it for basically 100 years and it's been difficult. There are cultural things in play that have prevented us from regulating the commodities markets just like we regulate other financial markets. But we need to change that. It's not an excuse just because it was done that way in the past, and it doesn't mean it's the right thing. Okay, if we let Enron slide and didn't put in Sarbanes-Oxley, how would we feel about company financial statements? That SOX regulation is there for a purpose. Why not do it in the commodities? Why? Why? No answer. There's no answer. In any case, this is going to wrap up this series. Stay tuned to the channel. Don't leave the channel. We've got tons of stuff that you guys can look at. If you want to look at another investigation we did, look at the Permit where Daniel and I broke down what they were doing. That's an awesome series, and check out some of the other playlists on the channel. And then next week, we're going to be talking about SLV. Stay tuned. We're going to do another investigation into another market vehicle for silver. And I think you guys will find that interesting. Until next time, this is Rob Keens with Gold Silver Pros.